Hi class, I'm Matt Fisher, your accounting professor. We've gone over a lot of videos associated with plant assets and depreciation and lump sum purchases. Well, this is the last video in this series of videos for plant assets. We're going to be looking at disposal of assets. And in this video, we're going to go over 4 different assumptions when we dispose of an asset. So let me give you some preliminary information. We've got some equipment for $250,000. And so far we have depreciated it a total of $150,000. So right now in time, this is the correct balance for accumulated depreciation, $150,000. So you can see here our book value is $100,000. So in assumption number 1, let's assume that we're selling this for $100,000. It's book value. So the journal entry would then be cash $100,000, and then we would debit the accumulated depreciation $150,000. Now we need to do that because accumulated depreciation has a credit balance. So we need to debit it to zero it out because we're disposing of this asset, we're selling the asset. So we have to zero out accumulated depreciation. Now we also need to get rid of this equipment account. So I'm going to put down here equipment. And the equipment account has a debit balance. So we need to credit the equipment $250,000. And since we're selling it for $100,000, you can see we're actually in balance here. So we're done. This is the journal entry if we sell our asset for its book value. We debit cash, and then we eliminate the accumulated depreciation and the equipment accounts. So we're going to debit and credit those accounts to zero them out, and now we're done. In assumption number 2, let's say that we're selling this for not $100,000, but $130,000. Okay, so our cash then isn't going to be $100,000. It's going to be $130,000. This information did not change, so I can leave these on the board. I'm still going to debit accumulated depreciation $150,000 to eliminate that credit balance. I'm still going to, debit accumulated depreciation. I'm still going to credit equipment $250,000 to eliminate that account. But you can see here that I am now not in balance. My debits are $280,000 and my credit is only $250,000. So I'm gonna need another $30,000 right there. What is that? Well, that is a gain on the sale because the book value of this is $100,000, but I sold it for $130,000. So I have a $30,000 gain. So I'm going to put down here, gain on sale, and you'd say gain on sale of the asset, okay? Of $30,000. Think of this as like a revenue account. It's a gain account, but it's similar to a revenue account in that credit increases it. Credits increase revenue, credits would increase the gain account also. So that's assumption 2. We're selling it for $130,000. In assumption number 3, let's assume that we're selling this for $80,000. So let's take a look at this. The book value for this asset is $100,000 because once again, this is a debit, this is a credit. So together, that's $100,000 book value. We're selling it for $80,000. So my cash then is $80,000 here. I have to get rid of my accumulated depreciation. I have to get rid of my equipment account. My journal entry does not balance because the book value is $100,000. I sold it for $80,000, so I need another $20,000 here. All right, so now this is $250,000 of debits, $250,000 of credits. What's this going to be called? Remember, when it was over here, it was called a gain on the sale of the asset. All right, I think you got that. It's loss. loss on sale of the asset. Think of it like an expense. Expenses have debit balances. Losses are similar. They have a debit balance. All right? So it's reducing your net income. Now, let's take a look at assumption number 4. In assumption number 4, we just discarded this asset. It has no value to us at all anymore. Okay? So, let me erase that right now. So we didn't sell it. It just didn't have any value to us anymore, so we got rid of it. Well, we have to eliminate these balances. It's on our books at a net of $100,000 still. So we have to get rid of accumulated depreciation. We have to get rid of equipment. We're not getting any cash. So those are our journal entries. So what do we have left? Well, unfortunately, we have a loss on disposal of the asset. Okay, because it had a value still of $100,000 on our books. We're getting rid of it, so we're going to have a loss then of $100,000 for this asset. So those are 4 different types of assumptions. Make sure that you go through each one of them carefully. They're not really that hard. If you understand your debits and credits, you understand what's taking place, they're really not that difficult. Right? So take some time, go through them, really try and understand them, pay really close attention, and follow what's taking place. All right, class? I hope these videos have really helped you out. And remember that there are lots of other videos, not just accounting videos, but we have math videos, we have science videos, we have Spanish videos. We have all sorts of videos that can help you with your studies. All right? Good luck, class. Hope to see you again soon.